So let me introduce our panel on financial reform. Starting from your left, we have Ricardo Caballero, who's the head of the economics department at MIT and the Ford International Professor of Economics. He is a distinguished economist and also a distinguished macroeconomist. Next is Debbie Lucas, who's now at MIT. She's the Sloan Distinguished Professor of Finance. For many years she was a professor of finance at Northwestern. We were very fortunate to be able to bring her back. But when we tried to bring her back, there was some delay because she was in Washington working on policy issues. And so she is a perfect fit for the part of the new agenda of MIT Finance, which is to get much more engaged in policy issues going forward. Next, we have Ben Golub, who's an MIT alum, who is a founder and chief risk officer of BlackRock. I remember Ben very well from his days at MIT. It's great to have him back, and great to have him so generously engaged in the finance group at MIT and in MIT Finance. And finally, we have a surprise mystery guest. It's Andrei Kirilenko, who is the chief economist of the CFTC, the Commodity Futures Trading Commission. He has been in the thick of all of the policy work and regulatory reassessments that have been going on with your commission, but also the SEC and the Fed and all the other Washington organizations that have a hand in financial regulation for the last, well, ever since the crisis started. I'm sure your job got more and more interesting every day. We are very fortunate to have him come, and we asked him to join the panel. So that's the panel. The head of the panel is Andy Lowe, who you already know. So I will just ask Andy to come up and replace me, and we'll get going.
Thanks, Stu. Well, it's a real pleasure and privilege to be the moderator for this extraordinary panel. You know, you've heard from Stu, Bob, and Antoinette about the importance of practice in our theory and our data gathering. And I couldn't imagine a more impressive and informed panel who's going to be discussing current issues about financial reform. The format is very simple. I'm going to ask each of the panelists to start with a 5-minute opening statement. And then I'm going to ask each of the panelists one question just to get things started, because I know how polite MIT audiences are. So hopefully the majority of the time will be yours to be able to ask our panelists questions. So with that, why don't we start from left to right? Andrei, you want to just start with a brief 5-minute opening statement?
Thank you for having me here. It's a great pleasure to be here in front of this audience. I'm very glad to see such a distinguished group of people in the room. I've been with the CFTC for about 3.5 years. In the last couple of years, I've been the chief economist. As chief economist, I've been significantly involved with the rulemaking process that CFTC is going through, some of it jointly with the SEC and other government agencies, to basically implement Dodd-Frank, the Dodd-Frank Wall Street Reform and Consumer Protection Act. We have about 60 different rulemakings that we have in the works. We have about over 30 teams, and I have an economist who works in my office on each and every team. And on each and every team, they work on the cost-benefit issues, the economic impact of each rulemaking that the Commission promulgates, which gives me a unique perspective over the entire panoply of rules that we are putting in place, how we are very quickly redesigning basically the derivatives markets, both in the United States and globally. I'm also, through my job, involved in a number of other initiatives that the CFTC is again, together with our government agencies, is involved in. One of them is the change in nature of our market structure, which is our markets became electronic. Our markets are now populated by algorithms. Algorithms trade with algorithms. What does it mean for market quality? What do we see in our data? We have a unique set of data that we have. On a T+1 basis, we receive positions and transactions of all market participants in our markets. So we can actually empirically validate and see footprint in the data of different types of traders. Another set of issues that has to do with sort of implementation and financial reform that I find is you have issues related to regulation, you have issues related to finance, and a big issue that we're also facing is data. And so I am the chairman of what's called a subcommittee on data standardization of the Technology Advisory Committee, and we are literally looking at how we can standardize this enormous amounts of data so market participants talk to each other, so regulators understand how markets participants talk to each other in the markets. So this intersection of regulation, finance, and data is where I see myself day in and day out, and that's a very exciting sort of opportunity for me to share what I see from what I said.
Great. Thank you, Andrei. Ben?
What I was asked to speak about was sort of my sense of the state of the financial system now, as well as the state of the efforts of reform. And, you know, parsing through the words, the best thing I could come up with was tenuous. That's sort of, it's a balanced statement. It's not too hysterical, yet it's honest. You know, we look around, we see both as part of some of the existing regulatory processes, as well as just common sense because of what's coming down the road. You look at the U.S. banking system, it's a lot stronger today than it was during the crisis period. On the other hand, you know, Europe ex Switzerland, perhaps, you see a very different picture, and you know, arguably it's on an element of life support based on the ECB and the LTRO financings that happened, and you know, some of the abstraction of these things look a little different when you're on the other side of it, and when you see at one point, you know, your own money market funds holding massive positions in European banks you never even heard of one period of time, and then you see nothing at all a little bit down the road, and you kind of see that major sucking of the financing out of Europe, and at least at the moment there's a standby. It's not clear where it goes beyond that. I guess we have some time to play it out. In terms of what's going on, probably the biggest thing hanging over certainly the U.S. banks has been the pending re-rating of the banking sector by Moody's, and you know, it's a little bit hard to understand why a bunch of guys in a room making an opinion and publishing an opinion really matter. But then you get into the nitty-gritties of the financial system, sort of, I guess I call them sort of the rigidities of the system, and you know, we count the hundreds of customers whose guidelines say thou shalt not invest or transact with an institution that those fellows in that room you know, call, let's say, a triple B. And the cumulative effect of that, you know, is rather large, and you know, we're going to have to adapt and perhaps adapt in a strenuous way to some of those changes if they pan out the way things are. So you do that, and then you kind of look at one of the ironic things is that at the same time that these institutions are about to be downgraded, if you look at them relative to where they were when they carried much higher ratings, you know, either they're wrong now or they were extremely wrong then, because they're generally in much better condition, much better run, much better balance in terms of their funding, much higher capitalization, yet they are being driven, you know, potentially out of certain businesses, and in some sense it may be the private sector's activity in implementing what I guess some of the regulatory reforms we're trying to do, and certain entities being forced out of certain businesses. So. In terms of financial reform, we have a lot of folks here who can speak on it perhaps better than myself, but this, you know, and being on the other side of the divide, we see also many of these regulations, and we're waiting to see what comes out of them. There is, you know, a fair amount of lobbying going on in this process, as you'd imagine, and you know, I think, you know, BlackRock's view is we're generally in favor of reform because this is the pond that we live in, that we function within. Yet, Individual entities may not agree with this part and that part, but the water's kind of polluted, and we all want to get it cleaned up. So we're hoping that Andrei said he was going to be there till the reforms, till the rules get implemented, and I asked him how long he planned to stay, and I hope that there's an alignment between his career planning and the success in getting the rules implemented.
Great. Thanks, Ben. Debbie?
I guess I wanted to say a few words about financial reform in the context of government financial reform. This is a quote that I sort of love. You who wish to reform everything, why don't you reform yourselves? I guess we could all use a little bit of that. In any case, a major piece of unfinished business regarding the financial crisis was the massive ramp up of government intervention in financial markets and its high continuing level. So in my view, until that ends, it really would be wrong to think of markets as having normalized. So just this, Bob Merton, who did use my slides, sort of went over some of these things, but just to say, this is, if you just look at traditional government credit programs, government loans and direct loans, they sort of grew with the rate of the economy for many decades, and they just ramped up enormously during the financial crisis. So just sort of breaking down that time series, but starting just in the last decade, the government has always had the largest number of credit programs in the area of housing finance, primarily the Federal Housing Administration, but also the Veterans Administration. That's the light blue piece that you're seeing there. The role of the FHA just ramped up massively during the financial crisis. The other market where there was just incredible growth because of the crisis was in federal student loans, whereas all other consumer credit markets were shrinking, student loans are going through the roof. And then if you really want to talk about the elephant in the room, it's Fannie Mae and Freddie Mac. So in 2008, the federal government took them into conservatorship. What I have there is they were ghosts before 2008 because they had implicit guarantees, and then if you add that explicitly, the government is backing about $8 trillion of various kinds of credit. As I said, a lot of it for student loans and for housing, particularly through Fannie and Freddie. And I also, so, when you say markets haven't normalized and there's a need for reform even in the government, just to elaborate for a second on FHA, I like to call them the last subprime lender in town because they're still making mortgages with only 3.5% of equity down. So just as an example. In any case, how can we ramp down what's going on? I think that's a discussion that more of us need to be having. There's a general agreement, I think, the administration thinks this, Congress thinks this, that the implicit guarantees of Fannie and Freddie were a bad idea and they shouldn't be reconstituted, that there should be a wind down of government involvement in the housing market. But I think really the challenge before us is how. The transition is going to be incredibly difficult, and I think sort of evidence of that is how little you're really hearing about it. I think people agree that we're going to have to increase mortgage guarantee fees and maybe reduce the conforming limit to wind them down. But when? When will policymakers believe that the markets are robust enough to be willing to step back? There's a lot of gridlock. Congress has to agree. The administration has to agree. I just want to mention one more thing by way of conversation and telling you about something that I personally have worked on for a long time and care passionately about, which is I think sort of an added piece of why it's going to be so difficult for the government to step back from these programs is that by the government's own accounting, it looks like they make considerable money for the government. So I told you the FHA is the last subprime lender in town, student loans very risky, but for the budget, those programs reduced the budget deficit. They created budgetary profits of about $12 billion. And this is because of the way the government accounts for risk. To bring it into which is to say they don't treat risk as having a cost. So my own agenda at CBO, which I'll tell you more about, not to take other people's time right now, has been to try to build an apparatus to produce fair value estimates of all these government obligations as a way of sort of helping policymakers understand that all these things aren't free. So.
Great, thanks, Debbie. Ricardo?
Thanks, Andrew. But let me talk about the philosophy that I see behind financial reforms and why I disagree with them. I think that at the core of Dodd-Frank and Dodd-Frank Plus and so on is, you have the idea, the basic goal is to enhance financial stability by increasing transparency and accountability, by eliminating too big to fail, and to protect the American taxpayer by eliminating bailouts. That's the grand view. And the grand view is, and so the idea is that somehow this is needed, and that the way to go, the fundamental problem is really that most of you, that means financial professionals, are crooks, or better said, the way we say in academia, you are subject to agency problems. And somehow if we solve the incentive problems that you face, then we will all be fine. And I think that's a fundamentally wrong view, in my personal view, of what the problem is. I think that in order to get to the kind of financial crisis, or the main ingredients in the kind of financial crisis that we had in the US, in developed economies in particular, you need sort of three ingredients which are very fundamental for the financial system. The first one, which I think is far more important than incentive. Incentive, don't take me wrong, incentives are extremely important. There are lots of incentive problems within the financial system. But I think by far the most important problem is mistakes. People just make very big mistakes. I don't think that Lehman, the actions of Lehman in 2006, 2007, were as a response to the anticipation of a bailout in case things went wrong, which is a typical argument used in the anti-bailout system. It's just they made a fundamental misassessment, underestimation of the kind of risk they were incurring. That's the fundamental problem. That's that people do make mistakes. I never understood this moral hazard type argument. I mean, I understand the mechanism, I can write models about it, and I can do all these kind of things. But really, the idea that it strikes me as a second or third or fourth order problem relative to the kind of losses that management suffers, equity holders suffer once one of these mistakes takes place. So the anticipation that this mistake will be ameliorated by a little intervention, I think, is second order. The same applies to the IMF and interventions on countries and so on. We may be on the other side of this thing, so that's the first ingredient. The second ingredient, I think, in order to get into a big crisis is complexity. I think that I'm very much for transparency, for improving all the systems we have, the trading system, to creating markets and so on. But I think the minimum complexity that a modern financial system has is way beyond what any human being can understand, certainly during the fast timing of a crisis. Okay? So that's a constraint. We better take it as a constraint that whatever we do is going to be way too complex. Now, that doesn't matter very much on your everyday life, because you don't need to understand the complexity of the financial network to do the kind of things you do every day. You need to understand what happens to your neighbor, to your little world. But if it happens that you do need to understand the complexity, you won't be able to do it. And that's exactly what happens during a financial crisis. You fear that, that there may be linkages that you didn't think about before that now may hit you, and therefore you face the need to resolve this complexity, and you can do it. Regardless of what a great job we can do, I mean, you're going to face that problem. And that takes me to the last ingredient, which I think is critical to understand both why crises happen and the kind of policy responses that are appropriate to crisis, which is that people panic. There's lots of experimental evidence, you, Andrew, know more than I do, that human beings respond quite well, especially you, so well-trained people, respond very well to risk, you know how to manage risk. But once you get into the environment of night and uncertainty, when unknowns become unknown, human beings respond in very different ways. And that's the territory of flight to quality, of panics and runs and all these kind of things. And I think any new financial structure that we build has to take that very much into place. So how do I see the current reforms in this spirit, with this perspective? Well, I see it very poorly. I think, again, there is a presumption that somehow the system will become very transparent, and therefore policymakers will know what to do both ex ante and ex post. I think that's extremely dangerous. That's maybe one of the most important sources of systemic risk. Is nothing more dangerous for a crisis than a policymaker that thinks it has the tools to deal with the crisis. That's dangerous. I think it's also, I'm also very worried about the idea of too big to fail. I think that, I'm not sure what that means, but it could mean that you want to break up the banks right now to make them small pieces, but if you want to provide the same financial services, it's not clear to me that a network that is made of 5,000 little banks is more resilient, is less subject to panics, is less complex than what it is to have a few big banks. In fact, even from the policy point of view, it's a lot easier to bring 12, 20 bankers to the room, to the White House in particular, than it is to coordinate 5,000 banks. So it's not clear to me that we're moving in the right direction there as well. Or if too big to fail does mean that banks will fail, large financial institutions will fail in the middle of a financial crisis because we seem to have the tools to deal with it, that strikes me is also extremely dangerous. I think, again, when you have people in panic mode, the likelihood of a mistake is very high, and people don't tolerate mistakes in that kind of environment. So I'm worried. I'm worried that really we're moving in the wrong direction. I think we're creating a system that is less resilient to crisis, that I think bailouts, by the way, bailouts, that you probably will talk about that, but bailouts, the Fed has made money. So what protection are what kind of protection are we talking about? The Fed has made money out of this intervention, and you're going to tell me it's exposed analysis, but I think the Fed has made money in this analysis. And in fact, Milton Friedman used to say that that's the way you disentangle between a central bank that is doing liquidity-type interventions versus one that is doing solvency-type interventions. Just see whether the bank is profitable or not. I think the Fed has been extremely profitable. And I'm very glad that I raised your blood pressure here.
Yeah.
That's my position.
I'm not going to take time. Right.
Okay, thank you. So, Ricardo, let me start with you, but with a question. And following along your theme about mistakes. So, you're, in addition to being a previous chairman of the MIT Economics Department, you are also one of the leaders of the younger macroeconomic generation developing new models for dealing with some of these issues. In your view, what went wrong with the current macro models that we were using, the dynamic, stochastic, general equilibrium models, and what can we do about that?
Well, I have two views on that. The first thing is I don't think that it was a mistake of macroeconomics as a field that caused the crisis, or I don't think it was even the responsibility of macroeconomics as a field to anticipate that this crisis would happen. It was very difficult. I think it's in the very nature of a very extreme crisis that it will surprise you. If it doesn't surprise you, it's not going to be a big crisis. And of course, there are many people that claim that they saw it coming and so on, but if you ask them what was the specific mechanism you had in mind, they typically had nothing to do with what actually happened. So that's called, I think, pareidolia, no? We tend to see patterns but in any event. So I think that the crisis to be as big as this one, it has to be unpredictable, and it has a lot to do with complexity. Again, all the risks are spread around. There were some big mistakes, undoubtedly, in the policy framework, but the mistakes were spread around, and it was difficult to see what was going on. So I don't think it was a problem of the field of macroeconomics that we weren't prepared for the crisis. I think the dynamic stochastic general equilibrium setup has nothing to say about this, will never have anything to say about this, and probably has nothing to say about anything that is too important in any event. But I think that there was another field within macroeconomics. I think it's in the intersection actually of what you do and what we do, which was in the periphery of macroeconomics, which is in the intersection between corporate finance, contract theory, macroeconomics, which has been working for a very long time on issues of crisis, complexity, systemic risk, liquidity, and so on. And I think that one of the small good effects of the crisis is precisely that now those things have become much more part of the center. Yep. And you can see new students writing theses on these topics and so on. I think so. I think the crisis helped their discipline. The discipline had very little to do to help the crisis. But having said that, I think that many of the good things that were done in the crisis, I think that Bernanke had in mind, for example, during his interventions, were very much motivated by the kind of insights that come from that literature.
Well, and part of those insights, I think, really have to do with looking at the data, looking at the accounting issues. And so, Debbie, let me get to you and ask a question about what you've been doing at the Congressional Budget Office, because you're one of the first to argue that government is a financial institution. And so can you elaborate on that and tell us what you've been doing at CBO?
Yeah, so, well, I'll try to make it short. So for over a decade and under 4 different directors, I've been working with CBO on these financial-related issues under the theory that if you think of the price system as the invisible hand that guides resources allocation in the economy, I think of the budget cost estimates as a very visible hand that helps guide allocations that Congress makes. And when those numbers are off, as they are systematically in the case of many financial activities, you're giving bad signals to Congress. Now, I am certainly not pretending that they look at the numbers and they say yes or no just based on that. You know, they're very complicated decisions and they're made for better or worse reasons, but certainly I think they take the numbers they get quite seriously, and when those numbers are wrong, that's a problem. So,
wait, Debbie, can you just, for those who don't know, can you just describe what is the mandate of the Congressional Budget Office?
Okay.
What do you do at CBO?
So what CBO does is it creates literally the price system for the budget process. So when Congress is considering legislation, be it the health care bill or what to do to reform Fannie Mae and Freddie Mac, there's a piece of legislation. That legislation has a cost. That cost has to come in under the budgetary caps that Congress sets for itself. CBO's numbers are the numbers that they use to make those trade-offs. So some people say CBO is sort of a miracle because, you know, both sides, the mark of a successful day at CBO is to get a complaint from both the Democrats and the Republicans about the same cost estimate. So, you know, because they're working for both sides, they feel that truth is their only refuge. And so it's been sort of very foresighted that a lot of directors, but particularly Doug Elmendorf, who's the current director, has sort of pushed this idea that if you give policymakers fair value information about TARP, about FHA, about the Federal Reserve emergency facilities, which by the way, ex ante had a significant cost because they were entered into at times when there was a lot of risk, a lot of uncertainty. Yes, disaster was averted, but if I went to Las Vegas and I put some money on number 5 and I came home with a pot of money, I wouldn't say I'd made a profit, I would say I was lucky. But in the theme of today, what we were doing, so I was given the privilege of forming a new division within CBO, a financial analysis division, and we were tasked with trying to evaluate the cost of all these things. And I have to say that without the insights of modern finance, without Bob Merton's sort of view of how to value guarantees, there's no way we could have made a dent in those things. In fact, you know, the government writes the most exotic financial derivatives under the sun because they're not constrained to make them profitable. They can write whatever they want, and then you have to price them. And so the further you are away from sort of normal market practice, the more challenging it is to try to assign what seems like a fair market value to the thing you're looking at. And so that's really where the kinds of principles that we teach and we learn come in. So I was pretty excited after that experience to come back. Andrew and some other people mentioned that we're trying to start the Center for Financial Policy, and aside from sponsoring research that's relevant to this, I think one of the missions of the center will be educational. Someone earlier asked the very good question, well, if you come up with these great ideas inside of academia, how do you communicate them to the broader world, to policymakers? And I think our vision is sort of, well, that has been a big gap. You know, people talk about the digital divide. I think there's a financial literacy divide between the government and the private sector. And this isn't only at the top. I'm not talking about bringing Congress here and trying to make them learn Black-Scholes, but I think it permeates down to the very basic staff level. So I've sort of gone out of my way to try to meet the CFOs of FHA and, you know, the people who are sort of at an important level in government, but they don't have the education that you all have. And things that I might say to you that would seem very natural, like take the Modigliani-Miller theorem. You know, why isn't the Treasury borrowing rate the government's cost of capital? Well, it can't be, because you can never finance risky investments with risk-free debt, right? There always has to be an equity piece. So you have this sort of hidden equity piece. That's why the cost of risk is real to the government. A basic insight, born at MIT, you all, I'm sure, get that in a nanosecond. Impossible to communicate to people who don't have the education. So I don't want to go on and on, but I am really optimistic that if we do have this sort of mission idea of reaching more towards policymakers, that is an avenue to change the way they look at what they're doing. Maybe make better decisions, maybe not.
Thanks. So Ben, let me turn to you and ask about BlackRock's role in all of this. Not only were you one of the founders of BlackRock, but you also founded BlackRock Solutions, which was responsible for providing risk management software and consulting to a large number of financial institutions. And I understand that BlackRock actually played a role in working with Treasury and the Fed in dealing with some of these things. Can you elaborate on that?
Sure. And the numbers that I'll say are from the Fed's website, so they're not, in a sense, numbers that are coming from me and my role at BlackRock. So what happened is when first when Bear Stearns started to fail, and there was a sort of a shotgun marriage put together with J.P. Morgan. J.P. Morgan would not take a large portfolio of securities because they didn't really understand the valuation of them. So what happened was the Fed basically took those assets, put them into something called Maiden Lane 1, and they provided financing for that, and J.P. Morgan sort of had a subordinate piece of that financing, and that was about $28.8 billion, and as of 12 December of 2011, that's down to about 7.1 billion, and BlackRock was the manager of that portfolio. Technically, BlackRock Solutions, because it was on the we needed to keep sort of a wall between BlackRock's asset management activities and the activities that were done in this liquidation portfolio. There was a Maiden Lane 2, which came out of the support given to AIG, and also a Maiden Lane 3. Maiden Lane 2, people may know a little bit less about, although it was about 19.5 billion. There was a huge securities lending portfolio that AIG had that was dramatically underwater. And again, it was sort of a classic mismatch, short-term liabilities, but illiquid assets. And in fact, I guess to your point, it was actually paid down in its entirety, and the Fed made a profit of $2.8 billion on that transaction. Now, just as an aside, and while I'm a big advocate of BlackRock and our skills, I do think that if I had the ability to have long-term financing at Fed fund rate, and I had the ability to control the Fed funds rate, you might have been able to achieve a profit absent BlackRock's incredible work on behalf of the federal government, but that's just a supposition. I leave it to others to prove it out. And then the Maiden Lane 3, which was the one that's probably a little more famous, AIG had written all these incredible CDSs on all this nasty securities, and the government chose to make good and pay them down, and the government then decided that they didn't want to sell those securities at the market, so they basically took all the securities and put them into this Maiden Lane 3. Where they sit, and that was about $25 billion. It's paid down to about $16 billion now. Now, one of the reasons why, and it's sort of going back to your question, these were things that were happening at a very, very rapid rate. Decisions were being made very, very quickly, and I do think that while there's sort of the ability to function as a fiduciary, you couldn't, absent the ability to have the technological bandwidth to take down, these billions and billions of very, very complex structured securities and analyze them extremely quickly. That was a critical part. So, there was some ruminations in the press. Perhaps we were somehow getting favored treatment, that it wasn't a competitive auction, that they didn't send out an RFP. Well, these things were happening in minutes and hours, and there were, literally hundreds of people were basically reassigned, and in a period of almost a weekend, do this kind of work. So it is the case that you do need the mechanical technology of analysis and the types of things that easy to think are virtual, but there is friction in finance in terms of being able to processing information, and so that was sort of a key to it. So all the analytics plus the technology and the training and the systems work, which I think a lot of folks here probably are very involved in, it really does matter, because when you're trying to deal with massive complexity in a short period of time, there's just no other way.
And we have a saying at MIT, what do you call a nerd in 10 years? And the answer is boss. So technology definitely does have an impact. So Andrei, let me turn to you and ask a question about the CFTC. The CFTC used to be a sleepy agency. And over the last few years, it's gotten extraordinarily interesting, partly because of market conditions, but also partly due to your efforts. And this is particularly relevant for MIT because obviously the CFTC is at the midst of the derivatives controversy. And if you believe Warren Buffett that derivatives are financial weapons of mass destruction, I guess that makes Bob, it makes you Albert Einstein. And then Andrei, it makes you the chief scientist of the Nuclear Regulatory Commission. But I'm not going to talk about derivatives. I actually want to talk about something else that I think is on everybody's mind, which is high-frequency trading. That gets to the heart of technology. The fact that we can trade at femtoseconds doesn't necessarily mean that we should be trading at femtoseconds. And you're actually heading up a subcommittee focused on high-frequency trading. Can you tell us what your thoughts are, what you're doing, and where this industry is going to be going?
Yes, thank you, Andrew. Just to learn in from the past, let me maybe tell people a little bit about Commodity Futures Trading Commission. It's a relatively new market regulator. It was only formed in 1975. And if you look at the history of sort of regulators in the United States, you see that there is a crisis, and then there are one or two or several regulators rise, new regulators. In the last crisis, we had some regulators who folded and some new regulators, like Consumer Finance, Consumer Protection Finance Board that were created. The CFTC was created after something called the Great Grain Robbery. So the Great Grain Robbery was an event when President Nixon went to the Soviet Union, shook a few hands, and said, "Why don't we trade in wheat?" And the next year, the Soviets secretly came to the United States and bought 50% of grain stock without telling anybody. Come the fall, prices skyrocket. There's a public outcry, and Congress creates a new regulator, Commodity Futures Trading Commission, which was started out as a sort of a small department of the U.S. Department of Agriculture. Then it had its own function. It was primarily at first focused on agricultural products. Most of them traded in Chicago. Then, of course, in Chicago, we had the introduction of financial futures and options. And as of now, probably more than 90% of exchange-traded derivatives are on financials. So commodity, in a sense, is anything that fluctuates in value. Basket of stocks is a commodity, wheat is a commodity, volatility is a commodity. Anything that fluctuates in value and for which you can find buyers and sellers is a commodity. Then come various sort of regulatory actions, and by some of them, new products that were offered by banks called swaps, and sort of the relatives were excluded from the oversight of the Commodity Futures Trading Commission. There were banking products, there were prudential regulators who were very well positioned to look at those products. They're very well trained in finance and all the related issues. And then we have the last financial crisis. We have the Dodd-Frank Act, and Title VII of the Dodd-Frank Act says that most of these instruments will now come under the regulatory regime of the Commodity Futures Trading Commission. Right in parallel, in the last 5 or 6 or 7 years or so, there have been changes in how what's traded on exchanges is actually traded. There's been a great sort of technological revolution, and it caught up with the derivatives world, as I said, about sort of 4 or 5 years ago. And what we started seeing is that basically when the sort of Globex matching engine was first introduced in Chicago, it was introduced as trading venue for after-hours trading. Specifically, it was negotiated with floor traders. That would be something electronic for after hours. And over time, it took over. And now, if you go to Chicago, they're basically the pits are empty. There's just a little bit of activity in options pits, and that's about it. So it's taken over how things are done. And there was an inflow of participants in how trading is being done as well. So when I joined the CFTC, I actually joined to do a research project. I wanted to apply network analysis to transaction level data. I thought network analysis, you have buyers and sellers, they transact. It's a very well sort of framework. We have microstructure models that seem to be sort of outdated for what we have now out there, tens of thousands of participants, algorithms, and all of that. And we started building analytical tools, network analytics, various machine learning methods. And that was we started out about 18 months prior to the event that sort of shaped a lot of the regulation and thought on it, called the flash crash, something that happened in the course of 30 minutes on May 6, 2010, when US markets went down about 10% and then bounced back up about 10%. And high-frequency traders were immediately implicated. They said, how can that be? Nothing happened. There was no major event. There was no news. There was nothing of that magnitude. It must have been some computer malfunction or something happened. Our markets are of such great complexity with algorithms not talking to each other. It must be high-frequency traders and all of that. We had the data. We had the tools. Flash crash happened on a Thursday. We received the data on a T+1 basis. We received data on Friday. On Saturday, I brought in my team, which is much smaller than BlackRock's, and said, unleash everything we've got. And in 48 hours, we had the results that we presented to our chairman. And we think, based on preliminary evidence, here's what we think what went on. We think that there was a triggering event in our markets, in derivatives markets, and then spread like wildfire to other markets through cross-market arbitrage and type of trading. Subsequently, however, we had to figure out just sort of what is the regulatory response, and what is the regulatory response, and what is the professional response to this. People said, you have to regulate these. I have to tell you, when I looked at the high-frequency traders who show up as high-frequency traders in our data, these were not the names I knew. These are not like names that you read in Financial Times. These are proprietary traders who do not borrow money. Therefore, they don't have to register with the SEC. They don't need to register with us because they don't hold positions overnight. They come in and they account, a handful of them, for 50–60% of trading volume in liquid contracts. As I said, and handful could mean a dozen. So who are these participants and what do they do? We looked into it. And there is an effort underway now to make this process public, to make this sort of information discovery process public, and hence the subcommittee. We brought on people from data vendors, broker-dealers, exchanges, academics together, because in order for government, you may or may not know it, in order for government to promulgate a rule or regulation, it has to be done in a public process. Public needs to know what's been done, not done behind closed doors, but in a way that's discoverable. And that's the process we're going through now, because that sort of world, high-frequency trading world, as I said, it's a proprietary world. It's a world in which very few people actually want to talk about, yet they've become so big and important. And so that's the process we're going through now, which is extremely exciting, because you get to basically put lots of people on the stand and say, what's your role in this?
Fantastic, thank you. And all of you can get access to these reports because they are public and available on the CFTC website. Let me now turn to questions from the audience.
So you have each used words like complexity, fast markets, so many details involved in this problem. And yet when we look back at the last crisis, we hear things like the top people in the banks, in the financial institutions, literally did not understand the instruments that were being traded. And so I just wonder whether in our thinking about how to go forward, whether there isn't some delimiters where even if the market would be smarter and faster with the complexity of these systems, we may have to refrain from it just to make sure the humans at the top can apply some just sensible judgment. And on other aspects of it, we may need that complexity, and we have to sort of set up some pretty strong firewalls around it. And I wonder whether you all are comfortable that we found the divide, or are we still lost?
Ricardo?
I can say 2 words about that. I think that the point I was trying to make is that there isn't enough refrain that you can have to eliminate the problem. So, as you said, you're going to have to find a divide, and the divide will leave enough complexity out there that the kind of things that happen now will happen again. And financial markets are very dynamic, so you're going to see new things happening, firewalls are going to be created, and so on. But I think the point I wanted to make is that I think you should take that as a constraint. Doesn't mean that you don't fight it and you try to improve it, and that's what technological progress is about, figuring out what happened in the last event and so on does for us. But this is a very dynamic market. There's enormous needs out there. Risks are very complex. There's no 5 risks. There's millions of risks that are being sliced and diced in very strange ways that, in some particular environment, we may think we understand them, but then there's a big change somewhere, and then the whole positions is flip around. So I think that the only point I was advocating is that we should take that as a constraint of the problem the policy problem we have to deal with. Is that we're not going to know all of it, that we're going to find surprises exposed, and that's a constraint of the problem. We shouldn't even dream that we're going to get close to solving the problem.
So you mentioned earlier the comment about FHA is like the last subprime lender left in the United States, and being a loan at 3.5%. So I've been thinking a lot about that because of, some people will say it's insane, some people will argue against it, and the people that argue against it will look at data that exists. For example, there's some data that exists out there that if you look at families that are 40 years and younger, sort of between 20 and 40, and you survey them, they come back and say only about 30% of them have enough money to put a 3.5% down payment on a house. So, maybe things get a little bit better over time, but we'd be talking about a generation of younger people where maybe only half of them own homes versus 65, 70% in the past. So that in itself has policy implications. And if people argue that 3.5 should go to 10, then we probably are creating an entire generation of young people that may not be able to, they'll just be, permanent renters. You combine that with the pressure younger people are under with student loans that they can't default on it. And I'm wondering from a policy perspective, even though we've created all these problems, whether we're trying to solve the problem by putting the back on the people that didn't create it, young people. And how do you think about that from a policy perspective? Given that there are a lot of people saying we got to fix the problem, it looks like we're going to fix it on the back of the young people.
Debbie?
So I'm very sympathetic with that set of questions, and I have to say that you're bringing up the first order issue, which is policy is about a lot more than how much does it cost taxpayers. So that's sort of where I was focused, but obviously the policies are important in their own right. In terms of giving people access to home ownership who only can put down 3.5%, it's not clear to me that you're really doing them a favor. So that's really the hard question, because when you're giving them a highly leveraged investment in a risky asset, and we all see the difficulties that people have when there's foreclosures, it ruins their credit. So I think in the US there's a question of rethinking home ownership and who should own, who should rent, how much, when, can we structure other products. So for instance, we tend to use credit subsidies through these government loan programs to try to encourage people to own houses. Maybe we should be giving down payment subsidies instead, because that would give people more of a capital cushion. Anyway, I don't want to give any particular answer. I am sympathetic with the problems being large. But I will say that, so just in terms of the government sort of making these problems sometimes worse, why have student loans grown so much? Well, they're heavily underpriced. If you are a family and you have a student who qualifies for a student loan, that's going to be your cheapest source of unsecured consumer credit on the planet. And so, maybe it's good to give student loans, maybe it isn't, but in fact the incentives through these government finance programs are, I think, in many cases quite distorted. But just one more thing on the housing, by the way, is that when you make mortgage interest rates lower by subsidizing them, that does tend to drive up the price of housing, which makes it less accessible to young households too. So the whole thing is very complicated. I think we need to think about these things better.
Yeah, back there.
From my basic understanding of the financial crisis in 2007, 2008, and as well as the European debt crisis, it seems to me that financial reform has always tried to catch up on the problem. Is there a way for regulators to sort of be proactive without crippling market innovation, without crippling the industry?
Andrei?
Thank you. An excellent question. I think I think you may have heard in some of the recent speeches, especially the chairman of the CFTC, using the words adaptive reform. So adaptive is something that you adapt to current conditions, you adapt to sort of what's there, but you also try to anticipate what you think you're going to be adapting to. I think this flexibility is something that's definitely something that some market regulators especially are thinking about. How do you actually do it in practice? How do you go about it? So the way that we've sort of gone about it, if I may, and of course, as you can guess, these are my own sort of personal remarks, is that we've really thought hard about transparency, about what do you give to markets and to the public so that they self-correct, so that as much data as you can push out to the markets and to the public so that the public knows and is more informed to make these decisions. The feeling is that, and the feedback traditionally is that regulation and dealing with systemic events as well could be more adaptive and could be better, and some of the systemic events may not happen if market participants actually have the ability to see what they need to see, and then they'll panic less because they'll have the ability to understand what it is. And so at the CFTC, at least when sort of people talk to me about what are your views on this, I say, look, we receive a lot of data from the markets, and we need to be accountable to the public for every piece of data that we receive. We need to think about how do we push this data back out to the markets in a way that's useful. We started a whole bunch of reports, for example, and some of these reports came out as a result of the flash crash. We realized that there were particular type of, on the buy side, particular type of algorithms that market participants were using that were targeting something that they were constructing out of the market feed. And we found that, well, if you're just looking at the market feed, you're not actually looking at the overall aggregate things of what happened in the markets. We actually have this data. We can push it out to you. And then you can train your algorithms to do something that would be a lot more useful for your algorithms. And then maybe systemic type events like the flash crash may not happen. So that's sort of where the thinking is now. But again, it's adaptive. If we find out that the information processing actually translates into adding more complexity, then we'll need to rethink again.
Well, thank you. I hate to close things off, but we're short on time, and I want to make sure we have plenty of time for our closing speaker, Steve Ross, who's going to tell us about how to predict the stock market. We don't want to shortchange that. So please join me in thanking our panelists for this fascinating